Have you ever felt overwhelmed by the countless trading strategies, indicators, and techniques available? Do you sometimes wonder why no matter how hard you try, you just can't seem to make profits stick? Today's lesson is going to be a game changer. By the end of this, you'll understand why focusing on risk management is more critical than trying to predict market movements. This will be a turning point in our Risk First module, where we break down the myths surrounding trading and show you the simple yet powerful techniques to succeed. To start, let's break down what risk management means. In simple terms, it's about controlling the potential downsides of your trades. Think of it like driving a car. You can take the fastest route and hit the gas, but if you don't check your mirrors and signals, you'll increase the risk of a collision. In trading, we have to consider the potential loss of our investment, and that's exactly what risk management is all about. When we talk about risk in trading, we're referring to the possibility that we might lose some or all of our investment. This is what we're trying to mitigate with risk management. There are different types of risk, such as market risk, liquidity risk, and emotional risk, but for now, let's focus on market risk. Market risk is basically the risk of losing money due to market fluctuations. Imagine you have 10,000 in your trading account, and you decide to invest it all in a single stock that's predicted to increase in value. However, the stock ends up decreasing in value, and you lose the entire 10,000. This is a simple example of market risk, where the potential downsides far outweigh the potential upsides. But here's the thing, most beginners make the same mistake over and over again. They get swept up in the excitement of a potential big gain, and forget to think about the potential losses. They start thinking, this is going to be the one that makes me rich. But in reality, the potential loss far outweighs the potential gain. This is where overconfidence comes in. Beginners often fall into the trap of overconfidence, focusing too much on prediction and making big bets in the hopes of massive gains. But experienced traders like us know that the best trades are those that offer limited risk and significant potential reward. This is where stop-loss orders come in. A stop-loss order is an instruction to sell a security when it falls to a certain price, limiting your potential losses. In practice, we should aim to limit our losses to 12 of our total capital, depending on our trading strategy and market conditions. But let's take it a step further. What happens if you're not just investing 10,000, but you have a 100,000 trading account? Should your stop-loss orders change? The answer is yes, because the amount of potential loss is much higher. To make matter worse, there's also something called position size. Position size refers to the number of contracts or lots that you trade at any given time. Let me give you an example to illustrate the point. Let's say you're trading a single stock with a price of 50. If you have a 10,000 trading account and you decide to trade 100 shares, that means you're risking 10 of your total capital. But if you were to trade a stock with a 1 price and you're trading 10 lots, that same 10,000 would only translate to a 1 loss if the price falls. As you can see, the amount of potential loss changes significantly depending on the position size and the stock price. Now, let's talk about the one rule. The one rule is a simple concept that can save you from massive losses. The idea is that you should never risk more than 1 of your total capital in a single trade. So, let's go back to our previous example of trading 100 shares of a stock with a price of 50. If we're trading a 10,000 account, we'd only be risking 1 of our capital if we traded 10 shares. To avoid falling into the trap of overconfidence, make sure you're setting achievable goals, and never invest more than you can afford to lose. In practice, we should aim to limit our losses to 12 of our total capital, depending on our trading strategy and market conditions. This way, even if our trades don't work out as planned, we'll only be risking a small percentage of our total capital. Now, let's get practical with a homework exercise. Take any currency pair or stock and calculate its risk-reward ratio. If you're using a trading platform, you can use the built-in risk management tools to help you do this. Alternatively, you can calculate the potential loss and potential gain using a simple formula. For example, let's say you're buying 100 shares of a stock with a price of